Washington is putting a huge effort into delivering what President Donald Trump and his fellow Republicans call their one big, beautiful tax and spending bill by July or August. It's a massive legislative package targeting many issues, including tax breaks for companies. A couple of these tax breaks are especially important for companies investing in new factories or research and development. These breaks have their roots in Trump's 2017 Tax Cuts and Jobs Act. So let's take a look at what's changing and why it matters for investors. First, let's look at one provision that one veteran analyst at Capital Alpha Partners believes is most important for investors. That's immediate tax deductions for certain qualified equipment purchases. And these purchases now include certain factory structures. Under Trump's 2017 tax law, companies were able to immediately deduct 100% of the cost of certain equipment purchases from their taxes. But that benefit started phasing out in 2023, and this year they've only been able to deduct 40%. Now Republicans are looking to bring it back and make it retroactive to earlier this year. The bill passed by the House GOP would restore 100% expensing for 5 years. This would give businesses a full tax break on qualified equipment purchases the year they are made. This time there's also a push to expand what gets counted as equipment, and it looks like certain factories will now count. This could mean major savings for companies planning to build manufacturing sites. Analysts at Evercore ISI have stressed that it looks like the break will be limited to companies in the agricultural and chemical sectors, going by the House bill so far, but they say it's possible that pharmaceuticals could be added as well. So investors may want to keep an eye on companies in these sectors and see if other industries get added to the final version of the tax bill. Now the House bill calls for going back to giving companies a 100% deduction immediately for their R&D costs. But that year, a provision of Trump's 2017 law kicked in, and companies had to spread out their deductions over 5 years. Now the House bill calls for going back to giving companies a 100% deduction immediately for their R&D costs. As we can see from this chart, the sectors spending the most on R&D are information, which includes telecom and data processing companies, chemicals, and electronics. So investors in companies like DuPont and Comcast may want to keep their eye on this tax bill. So, what else should investors know? According to analysts at Evercore ISI, the current tax package actually has fewer business breaks than they expected. Sure, the tax breaks for factories and R&D are significant, but so far, there aren't any new incentives, and the tax break for factories is currently limited to just a few sectors. Analysts at Wolfe Research think the current package looks like it'll be modestly stimulative over the next few years, and it might fall short of what some investors had been hoping for. As you may remember, Trump's first-term tax cuts helped boost corporate earnings and sent stocks to record highs. Many investors have been hoping for a sequel. The bill is expected to pass the Senate in July or August after House passage in May. But delays are possible, and the bill's details still could change before the final vote. If you invest in sectors that rely heavily on factories or R&D, this is something to keep on your radar.